Welcome to Breaking News to Trading Moves.
Today, we're looking at a piece of litigation that's moving through the courts.
That's right, and we're going to focus on the commercial side of it, specifically which companies might benefit and which might face some headwinds based on the outcome.
Our whole discussion is centered on an action taken by a major retailer against the U.S. government. We're going to explore the framework for identifying who gets financial relief and who loses a competitive shield.
Okay, let's get straight to it. The core event involves Costco, which you'll find under the ticker COST.
COST.
And they've started legal proceedings against the United States. And this isn't some small tax issue, is it?
Oh, not at all. This goes right to the heart of national trade policy. We're talking about duties that amount to billions and billions of dollars.
So what's Costco's play here? What are they trying to achieve with this lawsuit?
It's a very strategic legal move. They're trying to protect their right to get refunds on duties they've already paid.
The duties from the Section 232 and Section 301 tariffs.
Exactly, the ones implemented by the previous administration, but the whole thing is conditional.
Conditional on what? What's the trigger here?
It all hangs on the Supreme Court. There are other cases challenging the government's authority to even impose these tariffs in the first place.
Right.
So if the Supreme Court rules that those tariffs were imposed unlawfully, that they were procedurally flawed or exceeded executive authority,
Then Costco wants to be first in line with their handout.
that's the idea. They want to be legally positioned to demand a refund for all the duties they've paid over the last few years. It's about securing their spot.
That makes perfect sense. So it's a protective move. Today, we're going to stick to the analysis of what happens if they win. Who are the winners and who are the losers if these tariffs get rolled back?
Precisely. We're examining the potential market response, looking at the financial outcomes for companies all along the consumer supply chain. A reversal would reprice the whole sector.
Let's start with the litigation itself. We've established Costco, COST, is securing its right to potential refunds. But why now? Why is the timing so important if the Supreme Court case could be years away?
It comes down to the statute of limitations.
The legal deadlines.
Exactly. There are very strict time limits for filing refund claims against the government. Costco has to file now to meet those deadlines and keep its legal standing.
If they waited for the Supreme Court to rule, they'd be too late.
They'd likely miss the window to get back the duties they paid in the early years of the tariffs. This is just procedural housekeeping in a way, but with billions of dollars at stake.
And it speaks to the sheer amount of money they've already paid. I mean, given Costco's scale as a global importer, we must be talking about an immense sum.
Hundreds of millions, easily. It could even stretch into the low billions over the full period. It depends on how much of the cost they absorbed versus passing on.
When you think about their business, it really affects everything.
Everything. From the TVs and laptops to the clothes, the furniture, even the packaging on frozen foods. Any container that crossed the border had a duty payment attached to it.
Which was a direct hit to their cost of acquisition.
It goes right into their cost of goods sold, or COGS. It's an artificial inflation of their core costs.
And for anyone listening, COGS, cost of goods sold, is the direct cost of getting a product ready to sell.
Right. It's what they pay a manufacturer, plus shipping, insurance, and in this case, the duties. If you pull those duties out, that COGS number drops immediately.
The cash flow effect for a company like Costco has to be, well, enormous.
It's hard to overstate. This isn't just a minor adjustment. It's about getting back money that was a mandatory operating expense. If the courts say those tariffs were illegal, that money flips from a sunk cost into a recoverable asset on their books.
It's a massive injection of working capital.
A huge one. And you mentioned the contingency. There are really two parts to the relief they could get.
Okay, what are they?
First, there's the refund for the past duties paid. That's a one-time cash windfall. Goes straight to the balance sheet, boosts their cash reserves.
A nice one-time payment.
But second, and maybe more valuable for the market, is the future relief. If the tariffs are struck down for good, their projected COGS on every future order drops.
So all their future financial models look better.
Much stronger. Gross margin, EBITDA, all those metrics improve. And that stability, that predictability, gets priced into the stock valuation.
So a cash infusion now, and a better business model going forward. And this has to go way beyond just Costco.
Oh, absolutely. The big implication here is for every single import-driven company. If the Supreme Court sets the precedent that these tariffs were unlawful,
It creates a legal blueprint for everyone else.
every other company that paid those tariffs can then line up and pursue a similar refund. You could see a flood of claims.
A massive industry-wide recovery of duties. It would affect everything from how they value their current inventory to their long-term pricing strategy.
And think about the capital. A retailer that suddenly gets a check for, say, $100 million has so much flexibility. They can pay down debt, buy back stock,
Or they can get aggressive on pricing to take market share.
that's the weapon. And that's why the market is watching the probability of the Supreme Court decision so closely. It changes the economics of the entire retail sector.
Let's turn to those two sides of the coin then. The analysis we're looking at lays out a clear list of potential winners.
Right, these are the companies whose cost structures would see an immediate and positive change if the tariffs are reduced or refunded.
And we start with the biggest players in the game.
Category 1 is the warehouse clubs and big box retailers. The names that come up are, of course, Costco, COST, along with Walmart, ticker WMT, and Target, ticker TGGT.
WMT and TGGT. And it all comes down to their scale, right?
It's all about volume and how much they rely on imports. They bring in just immense quantities of general merchandise.
Everything you can think of.
Everything. Electronics, clothing, home goods, you name it. And when you operate at that WMT scale, even a small percentage tariff across billions in inventory is a gigantic operating expense.
So lowering those duties is a direct reduction in their COGS.
Directly. And that creates what the analysis calls a dual benefit. It gives them incredible strategic flexibility.
Okay, let's look at those two paths. The first one is internal.
Path 1 is all about margin preservation, or even expansion. If it costs them, say, $20 less to import a microwave and they keep the retail price the same,
That $20 goes straight to the bottom line.
straight to the gross margin. It boosts profitability without them having to sell a single extra microwave. And a sustained improvement in gross margin leads to better EBITDA, which is what the market wants to see from a mature retailer.
Better numbers attract more investors, which can lift the stock price. So what's the second path? The external benefit.
Path 2 is about market dominance. They can use that cost advantage to lower prices. They can pass savings to the consumer to drive foot traffic and defend their turf.
So WMT could cut prices on, I don't know, back-to-school supplies or something.
Exactly. If their cost for those goods is now structurally lower than a smaller competitor's, they can undercut them, pull customers into the store, and then sell them other higher-margin items. It's a classic retail strategy.
The cost relief becomes a competitive tool. They have a bigger buffer to play with than their rivals.
And it also lets them absorb other rising costs, like higher wages or fuel, without having to raise prices on the shelf. This helps them maintain their value proposition, which is crucial, especially when consumers are feeling squeezed.
Okay, that makes sense for the big guys. But the analysis also points to another group that's maybe even more sensitive to this.
Yes. The next category is discount and value retailers. Here we're talking about Dollar Tree, ticker DLTR,
DLTR.
Dollar General, which is DG, and ROST stores, ticker ROST.
And for them, the margins are already paper thin.
Extremely thin. Their whole business is built on rigorous cost control. They're often thinking about profit in terms of pennies per sale.
Their model depends entirely on that sharp pricing to get budget-conscious shoppers in the door. So any increase in their costs is a direct threat.
It's a huge threat. That's why duty relief is so vital for them. It all comes back to the idea of landed cost, the total cost to get a product into their distribution center. For a dollar store, the duty can be the difference between a product being viable or not.
Right. If tariffs stay, a company like DLTR has a tough choice. Either shrink the product, which customers hate, or eat the cost and wipe out their margin.
And they can't really do that. So getting rid of the tariffs allows them to keep those famous low prices without sacrificing what little margin they have. It just makes their business model work better.
So for these value chains, it's less about aggressive expansion and more about just stabilizing the business.
It's about preserving the core promise. It's about making sure their value proposition is still there. If ROST can get off-price apparel cheaper because the tariffs are gone, they can offer better deals.
Which enhances that treasure hunt shopping experience they're known for.
It does. The financial relief goes right into a better inventory mix for the customer.
All right, let's move to the third group of winners identified here. This one is a bit different.
This is the category of import-heavy consumer brands and specialty retailers.
And the names here are Best Buy, BBY, Nike, NKE, and VF Corporation, VFC.
Right, so these aren't general stores. They depend on very specific, often complex, global supply chains.
Nike doesn't just buy shoes off a shelf. They manage a whole global network.
Exactly. And VFC owns brands like the North Face and Vans. They rely on specialized manufacturing all over the world. Then you have Best Buy, BBY, dealing in high-value electronics that often got hit with high tariff rates.
So for them, the relief means lower input costs.
It's a direct reduction in the cost to manufacture and source their products. For NKE, the cost to make a running shoe or a sweatshirt drops if the duties on the materials or the finished goods go away.
And the analysis connects this directly to their ability to run promotions.
Hmm.
Why is that link so important?
Well, think about it. When your costs are already high because of tariffs, running a big 30% off holiday sale really eats into your margins.
It becomes very expensive to offer discounts.
Very. But with tariff relief, they have more room. They can run the promotions they need to move inventory and drive sales without crushing their profitability targets for the quarter.
And that kind of flexibility is something investors really value.
Oh, absolutely. It leads to clearer, more predictable future earnings. The management team isn't constantly fighting against high input costs. When NKE can give financial guidance that accounts for promotions without showing a huge drag on margins, their outlook just looks a lot more stable.
So the cost reduction acts as a kind of buffer against earnings volatility.
It really does. It smooths out the volatility that comes from this kind of trade friction. For a retailer like BBY, which is in a brutally competitive electronics market, the ability to be aggressive on price for a new TV or laptop without destroying margins is key to staying relevant against online sellers.
So whether it's the scale of a Walmart, the thin margins of a Dollar General, or the promotional needs of a Nike, the end result is the same. Lower COGS means either more profit or more competitive firepower.
And that's before we even talk about the one-time refund. A huge cash payment like that can be used to pay down debt, which strengthens the balance sheet and can even improve their credit rating.
Which has its own set of long-term benefits.
It certainly does.
All right, so we've covered the companies that stand to gain. Now we have to look at the other side of this. Let's pivot to the identified losers.
Yes, the domestic companies whose market position is threatened if these tariffs go away.
Because what helps the importer? Hurts the domestic producer who was protected.
It's the other side of the trade policy coin. The tariffs were put in place to shield specific domestic industries. You take away that shield, and they're suddenly facing a return to fierce global competition.
And that means downward pressure on prices.
Almost immediately.
Let's start with the first category, United States steel producers. The material points to Nucor, ticker NUE.
NUE.
And United States Steel, ticker X. So how exactly did the tariffs protect them?
The Section 232 tariffs made foreign steel a lot more expensive for anyone buying it in the U.S. The idea was to counter things like foreign governments subsidizing their steel industries, which allows them to sell it for less.
So the tariffs built a price wall.
A very effective one. It artificially inflated the cost of imported steel. And that gave domestic producers like NUE and X a ceiling to price under.
They could set their prices just below the new higher cost of the imported stuff and still be the better deal.
Exactly. It guaranteed demand for their product and let them maintain very healthy profit margins. They didn't have to compete head-to-head with global producers who might have lower energy or labor costs.
It was a protected premium market for them. So what happens if that protection disappears overnight?
The consequence is immediate price erosion. Cheaper imported steel floods back into the market at its old, lower price. You have a sudden increase in supply at a lower cost, and that forces the domestic mills to drop their prices to compete.
And for a commodity producer with huge fixed costs, that kind of margin compression has to be incredibly painful.
It's a major squeeze. They have to choose. Either cut prices to keep their sales volume up, which kills their profitability, or try to hold prices steady and lose a ton of market share to cheaper imports.
Either way, it's not a good outcome for them.
Not at all. The analysis clearly sees them as being at risk because their profit models were based on that artificial price floor. Take it away, and they're exposed to global overcapacity.
And how does that show up on their financial statements, beyond just the margin?
It hits their ability to invest. Steelmaking requires massive capital expenditures. If their cash flow dries up because of lower margins, they have less money to modernize their plants or invest in new technology.
So it can lead to longer-term problems.
It can. In a worst-case scenario, it could even lead to shutting down older, less efficient facilities.
Okay, and the next category is described as a very similar situation. We're talking about aluminum and other industrial metals producers.
Right. The names mentioned here are Alcoa, ticker AA, and Century Aluminum, CENX.
AA and CENX. And it's the same dynamic.
It's the exact same story. Aluminum is a global commodity, and its price is very sensitive to trade barriers. The tariffs gave domestic smelters the same kind of support, allowing them to keep prices firm.
And I imagine their cost structure is also a factor.
A huge factor. Running an aluminum smelter uses an incredible amount of electricity. U.S. producers often have higher energy costs than their state-subsidized foreign competitors. The tariff acted as a buffer against that.
So if you take that buffer away,
The outcome is pretty clear. You get an increase in competition from imports, which squeezes the profitability for companies like AAA and CENX. Their margins were being propped up by that barrier.
and once it's gone, the global supply rushes in.
It does, and it immediately puts pressure on the domestic price structure. And just like with steel, these companies have very high fixed costs. A drop in their selling price can quickly impact their ability to service their debt or fund basic maintenance.
The operating leverage is high, so a small drop in revenue can have a much larger effect on their net income.
That's why they land so firmly in this camp. They are just very vulnerable to being undercut on price as soon as that government protection is removed.
Okay, that covers the raw materials producers. But there's a third group of losers that's a little different. Domestic manufacturers who benefited from this protection.
Yes, these are the companies that make finished goods. We're talking about appliance maker Whirlpool, ticker WHR,
WHR.
and Polaris, which makes recreational vehicles, ticker PII.
So they don't sell commodities. How are the tariffs helping them?
This gets back to that idea of a pricing umbrella. These companies benefited indirectly because the tariffs raised the cost of the imported products that compete with them.
So it made their competition more expensive.
Precisely. Let's use Whirlpool as an example. Their refrigerators and washing machines made here in the U.S. compete directly with models made overseas.
The tariffs increased the landed cost for those foreign-made appliances.
Right. So imagine a foreign-made washing machine would normally cost an importer $1,000. With a 25% tariff, it now costs them $1,250.
Okay.
That allows Whirlpool, whose domestic manufacturing cost might be, say, $1,150, to price their machine at $1,200. They make a $50 profit, and they're still cheaper than the imported one. The tariff gives them that critical pricing room.
And it's the same for Polaris, with imported ATVs and snowmobiles facing higher duty costs.
Yes. But if that protective advantage disappears, the whole game changes.
That foreign washing machine comes back in at its pre-tariff price.
And can now be sold for, say, $10.50, dramatically undercutting the domestic price.
So Whirlpool and Polaris are then forced to discount heavily just to stay in the game.
They have to. They have to adjust their prices quickly to compete with the now cheaper imports. And that action puts immediate and severe strain on their profit margins. It forces them to completely rethink their financial projections.
It sounds like a forced margin contraction because they can't just lower their own manufacturing costs overnight.
That's the challenge. Their labor, their logistics, those costs are relatively fixed in the short term. The only thing they can really change quickly is their selling price.
So they have to choose between keeping their margins and losing sales, or keeping sales and losing their margins.
And that's a tough spot to be in. The removal of that pricing umbrella is a direct challenge to their profitability. They go from a protected environment to a very aggressive, price-driven market.
And that kind of uncertainty, the likelihood of having to issue lower profit guidance, usually has a negative effect on companies' valuation.
Which is why they land in this category. Their pricing power was, to some extent, reliant on that government intervention.
So to sum up the analysis of the losers, it's the companies whose business models assumed that these trade barriers would stay in place.
Whether they're commodity producers who need high selling prices or manufacturers who need their competition to be artificially expensive, the tariff rollback means market contraction and pressure on their margins. The relief for the importers comes directly at the expense of these domestic producers.
This has been a really clear look at how trade law connects directly to corporate performance, right down to specific companies.
On one side, you have the major importers, the retailers and brands who could gain flexibility, cheaper goods, and maybe even a large cash refund.
Which all translates to a better cost structure and a stronger competitive position.
And on the other side, you have the domestic producers, steel, aluminum, durable goods, who could face a sudden surge in competition and a real squeeze on their profitability.
It's a powerful reminder that a legal case like this about government duties can affect every single link in the consumer supply chain.
It really highlights how policy decisions from years ago, which are just now being tested in the courts, can determine the operational health of these huge corporations. It affects everything from their ability to expand to the price you ultimately pay for a new appliance.
It makes you wonder how quickly a company's financial outlook can turn when these kinds of market conditions are removed.
It does.
And it also brings up a final thought for you to consider. If these big importers do get massive refunds for duties they paid on products they've already sold, what happens to that money? Is there any pressure from the public or anywhere else to pass some of that back to consumers even years after the fact? Something to think about.
A great point to end on.
Before we go, we have to state this clearly. This analysis is based purely on the information provided by the author of the text we discussed. This is not financial advice.
Nor is it a recommendation to buy or sell any of the securities mentioned.
And for clarity, those included Costco, COST, Walmart, WMT, Target, TGT, Dollar Tree, DLTR, Dollar General, DG, Ross Stores, ROFT, Best Buy, BBY, Nike, NKE, and VF Corporation, VFC.
As well as Nucor, NUE, United States Steel, X, Alcoa, AA, Century Aluminum, CENX, Whirlpool, WHR, and Polaris, PII.
This information is purely the opinion of the author of the text we examined.
Thank you for joining us.
We appreciate you listening.